one of the things we always have to be careful about is the things that we may not be thinking about that could completely derail our savings plans, our retirement plans. And I don't want to see you wake up one morning and look at your bank statement, your brokerage statement, your 401k, and have a big negative surprise that you're not prepared for. So in today's video, I'm going to talk about one of those topics. It's not pleasant to talk about, but I think it's important we do, and that is war. What happens if the US gets dragged into a war? Obviously, there's a lot of geopolitical pressures, Russia and Ukraine, but more specifically, potentially China and Taiwan. Do I think that's going to happen? I don't know, but that's why we need to prepare. So, what happens to the stock market in times of war? I think you're going to be surprised. So, let's jump in. This is from the Motley Fool, and they have an article, Wartime in Wall Street: How War Affects the Stock Market. It's written by Jack Caporal, and I think he did an outstanding job on this article. Jack starts off saying the lead up to a conflict often generates significant market uncertainty, which depresses market stock prices. So that's not good. And then post announcement, rebounds are common, and surprise wars hit harder than others. And he gives two examples of surprise wars. The Dow Jones dropped 3.5% in one day, the day after Pearl Harbor, and it dropped 5% the day after the Korean War began. And I don't know what the numbers are for September 11th. That was also a war on the US. And the market was down significantly then as well. Obviously, a huge surprise. Okay, Jack's got a great chart that I want to go through, and we're going to start off with this left-hand column. So he lists the war, and then he says, what what happened 3 months before the start, and you can see World War II down 12.3%. You can see the Gulf War was actually positive 3 months before. The Afghanistan war was down almost 12%. Okay, now what about 3 months after the start of the war? You can see what those numbers are. The World War II, the market was still down 9%. And that's the only one that 3 months after the war, the market was down. And now let's see what the total performance is, the loss before and the gain afterwards. Did we make that up? Did we not? Um, and you're going to want to stick with me because I'm going to share with you what the performance is by asset class, and then later by stock sectors, which companies should we look for, which companies should we avoid, things like that. So the total performance annualized, you can see those numbers are pretty strong. We don't know how the S&P has done, and we're going to get to that. But it just shows you the importance of making good decisions and preparing. And that's why I'm proud to partner with this video's sponsor. It's Chapter, who is a Medicare advisor whose services are free to you and I. As I record this, Medicare open enrollment period is just about to launch. It goes October 15th to December 7th. And it's super, super important if you're on Medicare that you reevaluate your plan every year to make sure that you're on the right plan. And if you're not on Medicare yet, it's super important that you choose wisely initially. So for people that are renewing, rather than just automatically renewing, make sure that you're on the right plan for you. Maybe, your doctor's changed locations and they're not going to be available next year. Maybe your plan cost is no longer the most competitive plan cost. Um, maybe maybe your prescriptions have changed and you need to look and say, you know, is my old plan going to cover this new prescription? And that can be a big difference. In fact, Chapter's average customer saves $1,100 a year. That's almost $100 a month. That's real money. And importantly, there's no reason not to call Chapter. Their services are free to you and I. But the number one reason that I agreed to partner with Chapter is if your current plan is the right one for you, they're going to tell you that. And that's what I was looking for. Somebody who's bringing their expertise, their team's expertise to benefit you, not to maximize their revenues, not to maximize their commissions. You want their expertise to hear what your situation is and give you the best recommendation. Why do I feel they do this? I've heard from viewers that have called and have shared that that's exactly what's happened. And B, I've been fortunate. I've been able to spend time with several people from the team. Um, and they're set up the way that I think you and I want to be treated and have a team treat us. So they're about to get super busy. Sign up for them at this link, or pro tip, call the phone number that you see on screen now. The phone number is 323-805-8579. And thank you again, Chapter, for sponsoring this video. Okay, let's go back. So we talked about what's the total performance. Now we'll unblur that column so you can see it. These are all attractive numbers. Now, how did it do versus the S&P 500? We're going to get to that in a second. And importantly, it's also going to show us the asset classes that performed best. So first off, this is the period 1926 to 2013. How the market did for the S&P 500. It's not specifically called out here, but that's probably going to be closely indicated by the large cap category here. I do wanna point out one thing is, long-term credit. That is probably like bonds, but it's for companies that are not public yet, so it's called private debt. 5-year notes, I'm assuming, is 5-year debt with the US government, 5-year treasury notes. And then what the cash return here is, so you can see what the all wars have done and which category's done the best. The category that historically has done the best, it doesn't mean it's going to in the future, is the small cap, and large cap has done very, very well also. Okay, that is by asset class, but what about, are there certain types of companies that tend to do better than others? Again, this isn't financial advice. I don't know your situation. This is going to be according to the article. What are the types of companies that do best? And before we go there, because it's not financial advice to you, I want to talk about, in general, how do we protect ourselves? Um, and we protect ourselves by getting our asset allocation right. That's going to determine 75, 80, 90% of our success as an investor. Um, we protect ourselves by having a long-term allocation that we can stick to over time. So if there is a scary event like a war, think about September 11th, how scary that was, how different the world was, right? But people who stayed the course and said, okay, I don't need to touch this money for a decade. And yes, this is scary. And yes, I wish I had gotten out a week ahead of time. They did just fine, right? So getting that asset allocation, you get both of those by having a plan. I suggest you work with a fiduciary financial advisor. I know many of you would prefer to do it yourself. If that's you, there's nothing wrong with that. The only thing I would say is use software designed to help you do as good of a job as possible. Don't build your own spreadsheet. Don't use Google Sheets. Don't use Excel. Too easy to make a mistake. And I can tell you, your spouse doesn't trust your spreadsheet. So use software designed for people like you and I. The software that I like is easy to use. It's powerful. And fortunately, it's affordable. It's called Bolden. You can sign up for it in the link showing up here. Used to be called New Retirement. Okay, now let's talk about which stocks did best. Back to the Motley Fool article. The article says 3 long-term studies showed that defense and defense-related companies consistently outperformed during wartime or heightened periods of heightened political risk, particularly immediately after U.S. Intervention. A National Bureau of Economic Research study that covered 1937 to 2017 found that higher military spending resulted in lower stock volatility up and down for defense companies in related industries like steel, coal, textiles, and food. Wartime defense contractors provided stable revenues, which reduced the uncertainty of the future profits and made earnings easier to forecast. But it's important to note that many of these gains were short lived and often reversed within months. So again, it's about making good decisions versus trying to pick the winner in any given year, trying to find out what's going to happen and get in and out of the market. Super important decision is that long-term asset allocation. What percent of your portfolio is in stocks? What percent's in bonds? And I want you thinking about your bonds not necessarily as 30% of my portfolio or 40%, but how many years worth of living expenses do you have in bonds where you won't have to touch your stocks? Because that's going to give you peace of mind when something scary happens. So, making good decisions is important. And one of the most important decisions we all need to make at one time in our life is at what age do we retire? And that's why I made this video here. Why waiting to 65 to retire might be a big mistake. Thanks for watching this video. Bye-bye.